If you had invested in the best performing European domiciled fund at the start of 2023, you would have more than doubled your money. In fact, if you'd have invested in any of the top 10 performing funds, you would have gained more than 50%. Do you want to know what were the best performing funds for European investors in the first half of 2023? And also which were the worst? Let's get into it. Okay, so here it is, the top 10 best performing funds domiciled in Europe so far in 2023. This comes from a hot off the press news story from industry outlet Ignites Europe, which quotes Morningstar data. Morningstar is an investment data company. It's worth noting that past performance is never a guarantee of future returns, but this information is useful because it shows the kind of outsized returns you can make for your portfolio when you make smart, selective investment decisions. So the top line here is that funds investing in blockchain and semiconductors have emerged as the best performing funds in Europe so far in 2023. This represents a rebound from last year when many of these funds experienced poor performance. Hey, quick one. If you want to make a really smart investment decision, go ahead and click execute on the like and subscribe buttons. That way you won't miss out on future investing insights. It really helps out the channel too. Thank you. So the best performing fund was the Van Eck Crypto and Blockchain Innovators UCITS Exchange Traded Fund, or ETF, which has 46 million euros of assets. And that fund generated a return of 151.3% according to Morningstar data. I'll do another video on the different types of funds that you can invest in, but all you need to know for now is that essentially an ETF, or exchange traded fund, is a liquid type of investment product that trades on a stock exchange throughout the day and tracks an index over time. That's why these are referred to often as index investments. The same Van Eck fund, which invests in companies that use blockchain to transform finance and other sectors, was actually the worst performing fund in 2022, so last year. And Van Eck says in the article that they attribute this year's success to a resurgence of Bitcoin and the wider cryptocurrency environment. Keeping with the theme, the iShares Blockchain Technology UCITS ETF was the second best performing fund, with an overall return of 94.6% in the first 6 months of 2023. Two semiconductor funds were also among the best performing funds in the first half. Semiconductors are an important component in artificial intelligence markets. Fineco Asset Management's MSCI World Semiconductors and Semiconductor Equipment's UCITS ETF enjoyed a 58.4% return, while Amundi's MSCI Semiconductors ESG Screened UCITS ETF returned 51.9%. These fund names sure roll off the tongue, huh? Two technology funds run by asset manager BIT Capital also generated returns of more than 51%. And other best performing technology funds included products managed by Axion, Nikko Asset Management, and JP Morgan, which all returned over 50%, as you can see in the table. All right, so what were the worst performing funds? Well, at the other end of the spectrum, the Lixor S&P 500 VIX Futures Enhanced Roll ETF lost 39.1% of its value in the first 6 months of 2023. In fact, if you'd have invested in any of the worst 10 performing funds, you would have lost at least 21%. Two complex derivatives products also made the bottom 10 worst performing funds in Europe in the first half of 2023. These are highly complex strategies designed to insure investors against losses when stock markets are falling typically. The problem is when markets are buoyant, they tend to lose money. In my opinion, only sophisticated investors should really invest in these products. What other areas were painful for investors? Well, commodities markets suffered in the first half of 2023. 4 commodities funds in the bottom 10 suffered losses of greater than 31%. However, mean reversion is quite strong in commodities markets, meaning that big losses are often followed by big gains. Commodity markets can be driven by other factors like the weather, natural disasters, and geopolitical events, so they can be quite volatile. But this can be attractive, especially when there is a floor to the cost of production, which means you can tell when prices are low and might be worth buying. Turkish equity markets had good performance last year, but one of the bottom performing funds here is the Turkish SICAV Equities Fund from Akbank, which received a negative return of 24.9%. BlackRock's S&P US Banks UCITS ETF, which tracks mid-size and large US banks, also delivered a negative return of minus 22.6%. And this chimes with BlackRock's mid-year investment outlook that I covered in last week's video, saying that banks could be challenged in the new regime. So what does this mean for your portfolio? Reviewing the best and worst performing funds in terms of gross returns really just shows how much dispersion and variation there is in performance amongst asset managers and products in Europe. There are over 137,000 funds for retail investors globally and about 60,000 in Europe. So it's going to be impossible to always know in advance what the best performing products are going to be. Nobody has a crystal ball. I think it shows when you think carefully about the market and the investment trends and themes that look attractive, you can express these views by intentionally picking funds that align with your views. If you pick well, the returns can be significantly higher than just buying a broad index of stocks. By getting granular, you can identify pockets of the market that are growing and more attractive. Themes like generative AI, climate transition, and aging populations point to where we are heading to as a society. And if you can invest in the companies that are set to benefit from these trends, then you stand to profit handsomely. I hope this helps. Until next time, keep investing selectively and effectively.